After a week of selling pressure, the dollar has staged another rebound as we head to our final couple of weeks for the end of 2024. Big CPI in focus. Guys, Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So the dollar has managed to finish in the green in the latest week after, remember, it encountered that heavy selling pressure the week before last, and that was just attributed to some profit taking, a bit of a needed technical correction, but also some month-end flows as well. So if you have a look here at my screen, you can see obviously that green candlestick staging a rebound there, protection around that big psychological 105.50 mark. Now, last week, when we look at sort of fundamentals and the data point, okay, obviously it's all about labor market data, and generally speaking, it wasn't bad at all, okay? It wasn't bad by any means, right? There was decent job openings, okay, via the JOLTS. We had the ADP privately conducted payrolls, which was generally in line, slight revision, slight worsening in terms of the revision there. But then obviously all focus was really on the non-farm payrolls. Now, the unemployment rate negatively ticked up to 4.2%, slightly above expectations of 4.1 in the previous, but really and truly, that's still a healthy labor market in terms of the unemployment rate. But then we had inflationary data in the form of average hourly earnings. So what people are getting paid is still decent, higher than expected there at 0.4%. Markets were expecting that to cool down. If people are still getting paid good wedge, good money, what do you think they're going to do? Spend, stimulate the economy, keeping prices, inflation sticky. That's obviously ahead of this week's CPI. And then, of course, the non-farm payrolls, a decent amount of jobs being added there, 227,000. Anything above 200K is bullish. Okay, it still contributes towards economic growth, and this is bullish. Now, heading into obviously this week, keep in mind that labor market data is still inflationary, and focus, of course, is on this week's CPI figures, where CPI is actually expected to remain sticky. Core 0.3. Month for month, 0.3, expected to be higher than previous. And then the year on year, the annualized, which is really key because it strips out all of the, you're looking at the bigger picture, it strips out the volatility of the near term factors with food and energy and all that. 2.7% expected there, higher than previous at 2.6. I wouldn't be surprised given that the economy is still freaking warm, right? People still spending money, the consumer's still generally confident. Why would we see inflation cooling? I just can't see it right now, especially heading into the the end of year period, contributions to with somewhat potentially with Black Friday, Cyber Monday. Maybe that doesn't filter through yet, but then of course end of the year, people are still spending money, heading into the festive period. So with the dollar here, as you can see, we had the setup for a potential downside, evening star, validated by that closure below, but then bulls coming back into gear and forcing a rebound here, as you can see on that weekly. For me, especially if we get higher CPI this week, I would like to see this just resuming to the upside. I know everyone was gearing up for potential big dollar correction, but when you look on the monthly as well, there's still room for this to potentially go and fill the month of November's wick to the upside. Why not? If all the fundamentals supporting it, I understand where obviously everyone's been so long the dollar, so long the greenback, and how much more buying power can we get? But when macros are so strong, can we really ultimately fight against that? It'll take quite a bit of doing, because remember, there's real money flows in the FX market as well that's going on. That driving flows in the money drive these prices. And if the macros are still there, if yields are still decent, if the economy is still stable relative to other economies, why would people not want to put their money in the States? Okay, so for me, I'd like to see some more buying pressure, so long as the CPI supports that. This psychological sort of 105.50 area supporting the price. What we could look to do is go and challenge this area of resistance here at the mid 106 region. And you could, I guess, somewhat debatably view this as potentially bottoming out there, 1-2, the neckline there. If we end up taking out this neckline, then obviously this is going to go and fly and re-challenge that heavy supply area at 108.80. All right, so this week, very much focus on that inflation data. Obviously, it's a big week, and we'll take a look at the other key data points. But as I say, if that inflation data does come out higher, remain sticky, I expect those dollar dips to continue to be bought. Also expect some volatility for the Australian dollar, because we do have the RBA rate decision. Now, these guys have remained, stand pat. They've stood pat in a while, keeping rates unchanged, higher for longer, because they want to bring down inflation. The Governor Bullock still thinks it's still too high. When we look at recent Australian data, we'll start seeing a little bit of cooling. GDP slightly cooler there than what markets were expecting, coming in at 0.3%, albeit still higher than expected, higher than the previous 0.2. We also had the retail sales, which was actually quite bullish, 0.6%. I think at this reading, okay, obviously, look, the RBA are expected to keep unchanged, and they do want to bring down inflation. But inflation, when you look here, let's just quickly bring it up. I just want to show you, inflation has been coming down. I know you still see it as too high. But look here at the previous reading down to 2.1. It is expected to be jump up to 2.5%, but we are still cooling. Okay, we are still cooling. I don't think they can be any more hawkish. We are moving closer towards rate cuts. I know their expectations were pushed back from February to May, but I don't think, I think the risks are still to the downside for AUD because markets are just priced in this hawkish RBA. And if anything, they're just looking for excuse now to get ready to unwind that and push the RBA closer towards rate cuts. Now, this week, with the RBA, after the decision, we've got the labour market data where we're expecting decent amount of employment change, but the unemployment rate expected to tick higher to 4.2%. Obviously, that could push us closer towards markets pricing in quicker rate cuts from the RBA if we do see worsening in the labour market. If we look at just AUD versus the dollar as a base case here, see we've seen a large amount of weakening, breaking out of this, this key supporting trend line that have been supporting the price to the upside here. We broke out, retested rejections, price forming a bearish pennant. We've had a breakout retest there, and it does look vulnerable to a drop down towards sort of 63.00 for AUD. And obviously, if the RBA, we don't see any change in tone, I think the risks are still to the downside, especially if we see a worsening in the labour market there on Thursday. Now, we've also got some volatility for the euro with the ECB rate decision where they're expected to cut rates by 25 base points. Now, obviously, I'm a massive advocate for euro downside because of the state of the Eurozone economy. When we look at the recent PMIs, they're heavily in contraction. Germany, France, the Eurozone as a whole. We're seeing high public debt levels across the Eurozone. We've had mess in Germany politically and a mess in France, and with the government obviously failing to pass that budget. It's a mess in the Eurozone. And I just can't see Euro being sustainable to the upside. I see risks remaining to the downside. Now, I'm expecting that 25 basis point cut from the ECB as expected. And I want to see a dovish tone from them, seeing risks to the economy to the downside, given obviously everything that I've just noted. But with euro dollar, we've been narrowing within this bearish pennant. I'll just go on the weekly first of all. Obviously, we staged a bit of a rebound with that dollar correction as well, profit taking. This could obviously go either way. Heavy supply at 106. I'm leaning still towards that downside breakout of this bearish pennant, this bearish triangular structure, however you want to look at it. I still see that screaming to the downside, in my opinion, especially with that monthly there as well. I've had a little wick to the upside. I just would like to see that filling that wick to the downside now and heading to the south. But obviously, we need that dovish ECB. We need them to leave the door open to more cuts, and we need them to talk down the Eurozone, the prospects of growth, and see some risks, some downside risks. I'd like that to be really made clear from Lagarde. I know they're wanting to keep rates a little bit higher, not rush because inflation's still a little bit sticky. If you look here at Eurozone CPI, EU CPI, just bring that up. The last reading, as you can see, is coming down, but still a little bit sticky there, 2.3%. So that's one of the reasons why they're not rushing to cut, aggressively, but they've got risks of stagflation, clearly, high inflation, low growth. But I think they need to act soon in terms of more action, more cutting, more aggressively. And let's see if she does leave the door open to more cuts and she does talk down the Eurozone economy. Because if she does, downside here, obviously this is dependent on dollar data as well. But I am a fan of seeing some downside for the euro. Volatility also expected for the Swiss franc, because we do have the SNB rate decision where markets are a bit split. They're leaning towards a 25 basis point cut, but there are some expectations for a 50 basis point cut because inflation's been dropping quite fast in Switzerland. Obviously, we've seen a bit of a slowdown in growth as well. So I know the new chairman, he wants to deliver some action. I think they'd have to surprise and deliver that 50 basis point cut in order for Swiss franc to really, really lose some ground. If they just cut by 25 basis points, then CHF is most likely to strengthen. So just keep that in your mind there. With dollar Swiss, look, in terms of sort of upside, we'd slowed down given the pullback in the dollar. We've seen a bit of a slowdown there. Obviously, on the monthly, it still suggests to me that we'd like to see a push to the upside, especially there's divergence at the end of the day. The FMC aren't cutting as aggressive as the SNB. So over the sort of the more medium long term, I'd like to see this push into the upside. But obviously, this is going to be dependent on what the SNB delivers this week. Okay, where, as I say, if they just do 25, CHF has an opportunity to strengthen. If they do 50 base points, then we're going to see weakness with CHF. Look, we've staged a bit of a rebound there after pulling back. At some point, I would like to see dips being bought, as I say, for that continued weakness of Swiss franc and strength for the dollar versus Swiss franc. But this is a key area here that needs to hold. Where we're at now, around 87.50. This range from 87.50 to 87.00 is a key region for me, where I'd like to see that being supported. And if the dollar bulls can continue this week, then we're going to get a breakout here, potentially a bull flag, and just resume to the upside. But again, very much dependent on SNB, what they deliver, and of course on US data in the form of CPI as well. And we had some volatility from the Canadian dollar. It is central bank week, guys. We've got the Bank of Canada rate decision where they're expected to cut by 50 basis points there. They've been one of the most consecutive or the most dovish central banks out of the G7 with their consecutive cuts, because we've seen cooling in inflation, we've seen a cooling in the labor market, we've seen a cooling in growth. Generally speaking, the Canadian economy is cooling, warranting these cuts, hence the fast and consistent action from them. Here you can see expected to cut rates by 50 basis points to 3.25% from 3.75%. Last week on Friday, we observed poor labor market data, a big jump up in the unemployment rate to 6.8% from the previous 6.5, higher than expected at 6.6. If we look at dollar CAD here, breaking out to the upside, obviously there is that divergence economically and on a monetary policy level. Had a breakout of a pennant here, big bullish candlestick. Watch some potential dip buying at this 147 area. As I said to you guys for weeks and weeks now, we're expecting this breakout and we're llooking for it to push 143.50, 146, 148, go and challenge these highs here of 2020, go and challenge these highs here of 2016. So dovish central bank action, leaving the door open, potentially more cuts, given the worsening in the picture and as the economy. So I expect CAD to continue to be an underperformer. So plenty of data here, even UK GDP there on Friday, a lot of volatility. Have an amazing and blessed week, and I'll catch you on the next video.